We're going to look today at Aussie dollar because it's trading under the 200 daily moving average. And I think there's considerable space to say that it's going to head lower. We're going to look at those specific reasons. And then the trading takeout today is going to be trade off of a framework and not a set strategy. We're going to find out why that is important as well. Make sure you like this video and hit subscribe if you want me popping up in your YouTube feed every day to improve your trading edge. I'd highlighted this a few weeks ago on the Aussie dollar, and I'd noted that, there was a big key level just up here at about 0.68. Let's call it 0.69, right? And that there were some levels to the upside to look to push through. But the big danger really was that we were going to collapse through the 200 daily moving average. And I've mentioned it just about here. And I think it's pretty clear as to what the actual situation has been. I did give a bias that it was to the short side, to be fair. And I think we're seeing that. And with the way that risk is sort of looking at the moment, we're seeing, the chip manufacturers really do their heavy lifting. Apple's doing quite well as well, above the 200 daily moving average. Tesla is bringing things down. But the larger tech firms that are making use of AI, they are the ones that are keeping the market a little bit more buoyant at the moment. And so Aussie dollar is going to respond in this way. Aussie is very, very correlated to risk sentiment. The dollar at the moment is very, very strong because we've seen a reversion in rates. So if I go to the US 10-year yield, for example, you're going to see that actually yesterday it's traded above the 200 daily moving average and it wiped out all of last week's decline. So this is basically showing that the market is perceiving interest rates to actually not really be changing that much. And in fact, after Powell's speech last week, it's repriced higher. So it thinks that the market is still going to be higher for longer. This is likely due to a lot of the data that's just come out. So we've just seen the manufacturing PMIs, for example, out of the US come out. We've just seen as well in Germany some strange data with regards to new factory orders. It showed that there was an 8.1% increase. The core was negative, and the 8.1% was likely due to a big Airbus order, but it's showing some relief in terms of the bad data and in terms of how maybe traders might interpret it, even if they interpret things wrong, because they don't necessarily see as quickly the underlying data. But there's been basically an improvement in sentiment generally over the last couple of days. And I think, in terms of how this might serve the US 10-year yield, it will just give a further bit of buoyancy to it. We are seeing, obviously, as I said, it's trading above the 200 daily moving average now. It's actually just tested it as support as well. So it would be interesting, in fact, to see if December's high gets breached. So if we trade above 4.3%, that means bonds selling off quite a bit, and there should be some sort of reacceleration above here. Okay, I would argue that the reacceleration begins here. Now, what could that reacceleration be sparked off by? Well, let's go to our calendar very, very briefly, and let's have a look at what we've got today. So we've got auction. Shouldn't really be anything there. Perhaps maybe if we look at tomorrow, so if we go to the 7th, there we go. Nothing really on the 7th, maybe the 8th. So Thursday we're looking at now. Jobless claims could be something, continuing claims could be something. Let's go Friday. Nothing on Friday, so it's quite an actually data light week for the US. So it will be, very interesting to see perhaps if there is an acceleration above here, which it looks like there could be indeed. Every time we've sort of traded like this, we've dipped around a little bit as we have been, say here. And if there's any other places, yeah, here. So it could be a situation where we just sort of meander for a while, but we are trading above it. And of course, this could just be a fake out. We trade all the way back lower, but this area here will be the most interesting to see if this happens. If we start to get above 4.5%, which I don't think we will, but for some reason there could be some form of reacceleration here, then the FX pairs that are counter to the dollar, so Aussie dollar, for example, you're looking at much lower levels, because remember, the macro drivers and the momentum shifts in FX specifically are driven by levels of surprise, and levels of surprise in interest rate differentials more specifically. So that's really what we're looking at here. So if we can consider if the 10-year yield starts to tick up to 4.5%, we're looking at here. We're looking at maybe even this level down here. We're looking at really facing a market which takes some rapid repricing. I'm not going to say we trade down here, but there's certainly some levels just above, where we're looking at 0.6, so spot 6. So it's really, really important here to pay attention. Now, we could fade it absolutely, and we trade back up here, or back towards the 200 daily moving average. But with the way the 10-year is setting up at the moment, I wouldn't be averse to making a bet that it does reaccelerate higher. So do watch for that, because that is the pain trade at the moment. I think lots of people, including myself actually, have bought bonds over the last 6 months. And I think that if there is some form of reacceleration of inflation, okay, which is what would be maybe required by the 10-year yield increasing to 4.5%, maybe that creates the conditions for a collapse in dollar counter FX pairs. So important thing to be watching here, and important to understand the correlation between yields and FX pairs here. Today's trading takeout is why you need to use a framework rather than a set strategy. Now, I'm sure everyone understands context and how one context is never really the same as another one. If you're consistently using a fixed strategy, you kind of disregard context a bit too much. And I'm going to make a guess that none of us here are really quants. So we're not looking at very, very specific and niche data, which can kind of be standardized over different contexts. So what does this leave us with? Well, this leaves us with the requirement to be a little bit more flexible with how we judge different markets at different points in time. Now, this framework might be more flexible based on risk management. It could be more flexible based on, what specific assets you might look at according to which view you have. Or it could be something much, much more simple. But the basic premise is that you want to have a framework that allows you to adapt to each different situation and how markets evolve over time.